Jonathan, I want to talk a little bit about the credit markets. The last time you were here, we were talking risky assets. We weren't talking about a credit bubble. It still made sense to be in high yield and distress. But when we look at yields, specifically in high yield, around 5%, some of these new deals, does it make sense to still be there?
Well, look, I think the short answer is it still makes sense, but maybe it makes a little bit less sense than it used to. So we have, I think we generate some really attractive returns in 2012 as the credit markets performed very well. I think there was talk of a credit bubble. We did not buy into the story that there was a bubble in credit. Our story continues to be the case, which is that if there's a bubble, it's the government bond market that's a bubble, not the credit market. So you're right. The yield on the high yield index these days is inside of 6%. But if you decompose that rate into the credit component and the rate component is about 1%. The credit component is still 5%. So it's not an unreasonable spread, but it's come in quite a bit. So we've gone from being, pretty heavily overweight to pulling in a little bit, but as risks have started to come up in Europe and so on. But we still think there's some excess return.
But does it give you pause when it seems like every new deal that comes to market is a blowout? Does it give you pause that credit investors are just buying everything out there and not doing their homework? And if the market turns, that could create a really bad situation.
I think that's true. We are definitely, we always are, but I think you definitely want to go through the issues and really understand what credit risk you're taking. So,
but are people?
I think there always is some that aren't and some that are. Obviously, we try to focus on the details. I think in the environment that we're in, with interest rates so low and such a demand for yield, I think there are probably some deals that are oversubscribed and probably shouldn't be.
Truth of the matter, Jonathan, is that everybody else is talking about a credit bubble, and you're talking, you just said it, about a government bond bubble. Why?
Yeah. Well, I think, look, you look at valuations. Why is because when we look at that credit spread, the credit spread has come in quite a bit, so maybe you're not going to get the same returns, but it's still actually around average levels of spread. But where is the disconnect? The disconnect is in the government bond market, and the work that we've done suggests that even though the short-term interest rate is at zero, and obviously the economy isn't booming, but yet we think that the existence of quantitative easing and huge purchases by the Fed at the long end has probably driven rates down 100 to 150 basis points more than they would be even given the current economic
10-year would be at 320 otherwise.
Something like 320, and I think there's a risk of a triple whammy, which is the economy improves, the Fed stops buying, stops quantitative easing, so that premium or lack thereof goes away, and then you have better economic outcomes, so the term premium increases again, and then maybe you have a third effect, which is everybody realizes, hey, we bought all these bonds that we really liked at 3% yield, but now they're yielding 5%. Now what do I do?
What is the potential timing of this scenario? I guess that's what's most important. How long do you think it's going to take for the scenario to play out?
Look, I think it's going to be bumpy, but we actually are pretty optimistic on the U.S. economy, and therefore we think the exit of quantitative easing is going to be sooner rather than later. We just
Do you want it to be?
Well, given how we're positioned in portfolios, I think we do want it to be. I think from a fundamental perspective, I think that means good news for the economy, more people getting back to work. So I think the answer is yes, and I think that's not necessarily going to be good for the bond market overall.
But there are so many investors who are bearish, but because we're in this quantitative easing phase, they've bought into the market, and that's great for you if you're long. So wouldn't you want to keep this quantitative easing machine going for those who are addicted to it?
Well, not necessarily, because what is it that we're long? What we are long is the credit component, and what we recommend to investors and what we're doing in our unconstrained fixed income portfolios is to actually hedge the interest rate risk. So you can do that very effectively by either buying floating rate securities like bank loans, or you can buy bonds and then hedge using interest rate futures or swaps. It turns the bonds essentially from fixed rate to floating rate, and what it lets you do is actually take the credit risk, earn the credit premium, but then avoid the losses when interest rates rise. And we actually do think it could be this year.